Hello, this is Josh Belk with the Belk on Business podcast. Thank you for taking a few moments to listen in again today. On today's podcast, we're going to pick up on this topic of reasons businesses fail. As we know, statistically, most business, a great majority of businesses, well over 80%, will never see year 5 inside of their business. Most of the businesses will close before it gets there. And the reasons why businesses fail, it varies. It really can kind of depend on a number of different scenarios, but kind of went through, jotted down some of it from doing a lot of listening and reading, and as well as also from experience inside of the accounting firm that I own, and kind of looking at our clients and seeing some of the reasons why their businesses don't succeed. Sometimes it results in them going out of business altogether. Sometimes these are barriers to them getting to the point of profitability or to scaling. And for others, it just kind of ends up being a situation to where they kind of just figure these things out, and the business can continue on, and they begin to address some of these issues. So as we kind of go through this list, you'll see certain areas that you'll kind of look at and you'll say, you know what, these are probably some areas I need to work on. Maybe your business is just kind of just rolling right along, but maybe these provide you some potential pitfalls that you fall into if you aren't staying on top of some of these things. And so today we're going to start on, what's number 11 on the list of why, some of the reasons why a business may end up failing. So the first one today is the business owner simply does not know his or her numbers. And so this has kind of become one of those things, and as an accountant, I am kind of partial to the number side over maybe marketing or in other areas. But essentially, your numbers are going to be the metric or the true gauge that's going to tell you whether or not your business is succeeding financially. Now, we can have other measurements of a business's success or failure. If you're a nonprofit, maybe it's impact, whatever the case may be. Even within your business, how close are we to hitting certain maybe non-financial goals inside of the business? But for most businesses, the financial is going to take the preeminence as it relates to the health of the company. And so, and for a business owner to understand their financial health, they have to have certain metrics that they're looking at regularly. And so for a business owner needs to identify what those metrics are inside of their business that's going to help them measure or gauge the level of success in their business. Unfortunately, a lot of business owners run their businesses the same way that many individuals, unfortunately, manage their personal finances. They take out their cell phone, they look at their checking account. Do I have money? I have enough money to make it through today. I'm good. Okay. Like an individual may look, okay, this is how much money I have, and how much of this can I spend and make work until my next paycheck. And when a business owner finds themselves in a position to where essentially they are trying to manage their cash flow almost kind of in a looking back manner, you will never succeed looking backwards. Okay. So if you're kind of okay, here's my cash flow today. This is what I brought in this last week. So this is what how I'm going to see. Hopefully I have enough. I brought enough in to make it to the next week, or they're scrambling. So there's very little planning. So a business owner really needs to constantly be looking at their numbers, regularly looking at their numbers. They should have certain metrics they look at on a daily basis. They come in, they look at some sort of a dashboard that they're trying to gauge. Okay, is our dashboard where it needs to be at some of those daily metrics? They're going to have weekly metrics. They're going to have metrics they're working on with their team. They're going to have metrics they look at monthly, quarterly, and annually. Okay, so there's the different types of numbers you're going to be looking at. I've recorded other podcasts, probably will in the future, as it relates to metrics. Go back and you can find I have an entire one, for example, on cash flow metrics, et cetera. You can go back and listen to those, and we kind of do a little bit of a deeper dive into what are some of those numbers. So a business owner, there are certain business owners, numbers that all business owners should know. What is the break-even point inside of their business? What are their fixed costs inside of their business? What is the cost if they don't bring in $1 that month? What is it going to cost them to keep their doors open? These are things you should know. You should understand your churn. You should understand your cash flow conversion cycle. You deploy $1, how long is it going to take for me to get that $1 back? And so these are certain numbers that every business owner should know inside of their business. As an accountant, okay, I should be able to go to my client, and if we're having a conversation, maybe I'm doing some business planning with them, or we're doing some tax planning, whatever the case may be, I should be able to ask them, how is this particular number doing? And so if I'm looking at some of these, not overly specific numbers, but I should be able to ask them, what is your break-even point? What are your fixed costs every month? These are numbers that every business owner should know. And I'll give you an example, one I've given on this particular podcast a number of times. There is one major number that I look at month over month inside of our business. And I know if that number dips below a certain level, I know that I need to make some changes. If it gets above a certain level, then I know there are other areas I need to work on. And so what we do here is we have a subscription model for some of our clients, and one metric inside of our business, and I ask two of my team members every month, what is this number? And then where is it risen? Is it fallen? And this is one number I look at that my team knows this is what the number is, and this is the number we have to hit. And that subscription revenue has to be equal or greater than our payroll. If it's not, then there's a problem. And so that is the one metric inside of my business that we look at every month. And so there should be that one metric inside of your business every month. We know if we hit this metric, we're going to be okay. If we don't hit this metric, there's a problem. And so dig down, figure out what that one most important metric inside of your business is as it relates numerically that you know that you need to hit every month. And you may not know what that is. You may need help finding that. And if that's the case, lean into someone who can help you, whether it's a fractional CFO, whether it's your accountant, whether it's an advisor that you bring in, whatever the case may be, figuring out what that metric is. But one big reason why business owners fail, they do not know their numbers. Next, poor tax management. This particular week, at the end of this week, we're approaching the individual extension timeline for tax return filings. And we see this over and over again, and literally I've had my team chasing down clients for tax documents, for numbers, this type of thing here over the last couple of weeks as we try to approach the timeline. It is amazing to me how few people do any sort of tax planning, any sort of management of their books, of their records. And so if they're poor tax management, a lot of times they just have poor business management as it relates to their books and records. And so tax management does not start on January 1st of the next year, doesn't start on April or March or whenever it is you're working on trying to file your tax returns, whether it's business or personally. Tax management, tax planning actually starts before the year even starts. And so for our clients, as we enter into the fourth quarter, we'll start planning year-end calls. But when you're going through and as we begin to kind of, what needs to be done for 2023 to either mitigate, maybe we need to move some things around before the end of the year. But when it comes to sitting down, working with your team, sitting down, doing some planning as you look into the next year and you have those goals, I've already had these conversations, already introduced some of these with our team here at the accounting firm. There are certain things that we want to do next year. And so we have that from the business planning, but also we understand, what are the tax consequences of some of the things that we do, that we're planning on doing. And so that tax planning and the tax planning and management process starts for 2024, it's going to start in 2023. Okay. And so as you kind of work through that process, you should be having some sort of quarterly meetings, some sort of quarterly calls, at least once or twice a year at minimum, to where you're digging through and understanding, what is your tax exposure going to be? What are some things you need to do inside of your business? What are some things you may need to do personally to manage the tax? It doesn't always mean a tax reduction. I was having a conversation with one of our team members, and they were kind of joking that with one of our clients, that if their tax bill hit a certain number, that he was going to fly into town and take the team member out to dinner. And the reason why he said that, because he understood that if he hit this number in as far as his taxes that are owed, that meant he had a top line, or he had a net income, a net taxable income number from his businesses and personally that hit a certain number. And so those were goals of his. And but that it really becomes part of the tax management process, understanding what that exposure is and planning for it accordingly. So poor tax management. I've seen clients that have literally gone out of business because they neglected taking care of their taxes. This can be payroll taxes. This can be ordinary income tax. This may be self-employment tax many times. Our clients seem to get hit most by not having a good understanding, and some of that falls on us, maybe not educating, but not having a good understanding of self-employment tax or alternative minimum tax or net investment tax. Some of these non-ordinary income tax items that can come and bite you in the rear end. So just poor tax management, not planning well or not planning at all. Next, number 3, poor decisions regarding debt. I've had podcasts once again entirely on this topic. I really lean into a scripture verse. Dave Ramsey mentions a scripture verse quite often when he's talking about personal finance, and I think this is true in the business world as well. The borrower is always, I repeat, always slave to the lender. I've had clients say there's good debt, there's bad debt, whatever the case may be. I don't know if there's any such thing as truly good debt. There's maybe better debt, less bad debt than others. But bottom line, as long as you have any sort of debt, I don't care if you have leverage on a property and you have good tenants in there and they're going to rent the property, guess what? You still have to make sure that mortgage payment is paid. Okay, you still have to make sure that lender is paid. You still have to make sure that investor is paid. And as long as you have those investors, you have those debtors, you have whatever the case may be, guess what? Somebody has to show up. You as a business owner in some way have to show up to make sure that asset performs. Okay, and so that means it's still going to require some effort of yours. It does not mean that it's a bad thing. Okay, it may be part of your business model, and that's all great and good, but just have an understanding that still always is going to put you in a position of being a servant or a slave to someone else. Okay, you still have that obligation to the bank that has to get paid. You're still in a position of being a borrower, which means that you are in a position of essentially being a slave or a servant to that bank. You still are going to have to make sure that asset performs. Where business owners really get themselves in trouble is when they start having to take on either living off of credit cards, so they're using consumer type debt to finance their business, or they get into using some of these more predatory outside lenders. They will lend easily. Their interest rates are through the roof. And it becomes one of those situations, especially now that we're in a rising interest rate environment, to where if you end up having to go that direction, your business categorically always means your business is in trouble if you have to go that direction. Okay, so make sure that you are planning, cash flow planning frequently. Understanding what direction is the cash flow taking in my business, and do I need to make some modification? If I see that my cash flow is starting to slow down, that my business is going to slow down because of the economy, this is going to be a real situation all of us are going to have to deal with over this next year. And that is, bottom line, the economy is not getting better. Okay, and with everything going on now, of course, we're facing possibility of more military conflict, things of this nature. Things are going to slow down, and so. Because of that, you should be cash flow planning. And so understand that, I may have to do some things. I may have to slow some things down. I may have to lay off some people. I may have to do certain things in this next year, but stay out in front of it. Okay, and making sure that you're not leaning into, I'm just going to take on debt because revenue it's been really easy to drive revenue in past years. I'll figure it out. Okay, not a good way of going about doing any sort of planning inside of your business. And so be managing your cash flow so you don't have to go on and take on debt. And so if, poor decisions regarding debt, another reason why businesses may fail. Next, wasteful spending. Just not spending money prudently. I think it is prudent for us to be very frugal inside of our businesses, and being generous with our people, I think, is important. And I think we should be generous with the people who come alongside us, who kind of pick up those weapons of war, so to speak, and kind of get in with us as it relates to this game of business. And I think they should be rewarded well. They should be compensated well inside of our businesses. I don't like hearing business owners cutting corners, trying to find the cheapest labor they can, not taking care of their people. Take care of your people, they'll take care of you. But I'm talking about wasteful spending, and it can come in a lot of different areas. Think about your tech stack inside of your business. Is everything you have, is it truly necessary? Spending money on consultants or coaches. I think we all should have coaches, but just kind of frivolously spending money on a coach for this, a coach for that type of thing. Just astronomical amount on marketing. We're gonna, we want, to have our face all over social media or SEO or all this other type of thing that may not really be doing anything for us outside of just bring attention to us, but we're not monetizing off of it. And so marketing, spending too much, having lavish place that we're renting, for example. This isn't as big of an issue as it used to be inside of our business, but where are you renting? What, office furniture, these types of things you just waste a lot of money on. So, masterminds, networking, what we call development, a lot of wasted money in these areas. I think we find a coach or two that's going to help us, stick with them, work with them, that type of thing. Don't be kind of just throwing money after, the next idea or the next coach or the next person that seems to have a good idea or the next mastermind that we can get into because, some really cool people in the room. Be very purposeful about these things and walk into those situations with a definitive goal of what are you going to get out of it. And then are we able to afford it? If you're able to hit both of those, knowing how you're going to monetize out of that room that you're going to go into, how you're going to monetize on adding to your tech stack, understanding for every dollar that you spend, how am I going to get that dollar back? And if that cannot be clearly defined on how am I going to get that dollar back, don't spend it. Okay, so that's one good way of kind of a gauge that you can use to try to determine whether or not a dollar is well spent or will be well spent or not. And then once you spend it, look back and say, okay, did I get what I was looking for out of it? If not, then don't continue on with the contract. Don't stay in that mastermind. Don't stay with that coach. You may have to let a team member go, get rid of some software, whatever the case may be. So wasteful spending. And next and last for today, the fifth point, failure to protect your equity. And failure to protect equity. I think maybe if any of us have watched Shark Tank, you may have seen this happen a few times to where where someone that's getting up there and they're going through and they're giving their pitch. And they get to the end, and one of the sharks says, "Okay, well, I'm going to give you, $10 million for 13% of your company," whatever sort of astronomical number that gets thrown out there, right? And then all of a sudden, you see the person giving the pitch. Look at them; they don't have the equity to give, and they're not able. They simply have sold off their equity and early on to friends, to family, whatever the case may be, because they needed cash to keep the business afloat. So now they have these people who did nothing but invest cash take over a majority of their business. So now the business owner finds themselves bootstrapped. Okay, make sure you're protecting your equity. And if not just always selling or giving your equity away. Sometimes you'll sell equity for cash to try to keep the business open, for that seed money. Sometimes they will give equity away in exchange for some sort of expertise that somebody may give to the business. Be very, very conscientious about how you go about doing it. Sometimes it's better just to figure out a way to pay that consultant instead of giving them equity. Sometimes it's better off to try to go and maybe find the cash someplace else, whether it's some sort of a line of credit or going to the SBA and getting some sort of a loan, that type of thing. That can be okay types of debt, not good debt once again, but it can be better than bad debt of bringing inside of your business, because that is going to be better than giving away your equity. Okay, so making sure that you're protecting your equity. Another real big area, it also creates big time issues when it comes to taxes, and that is some people not looking at their equity section of their balance sheet. Your equity in your business, and I've talked about this in another podcast, and I will continue going forward, that making sure you actually do have positive equity inside of your business. If you go down to you look at your balance sheet, a lot of times business owners don't, they're just focused on the P&L. But if you look at that balance sheet, if I see a negative number on that equity section, that means some sort of action needs to be taken, meaning there's some sort of a serious problem inside of your business that needs to be addressed. Protect that equity. Protect that equity just about more than anything inside of your business. If you're protecting your cash, that means you're protecting your equity. Okay, and so protect that equity, making sure that your equity is sound, you're not giving it away, you're not selling it for cash, whatever the case may be, just simply to get some cash inside the business to keep it operational. Protect that equity at all costs. Hold it sacred, and hold it close to you, and find other ways to keep the business rolling along, overselling your equity if at all possible. So reasons why business fail, the 5 we went through today: a business owner that doesn't know his or her numbers, not managing their taxes and their tax exposure, not making good decisions that it relates to debt, wasteful spending, and then lastly, not protecting the equity inside of their business. Hopefully this particular podcast brought you some sort of value. Once again, this is Josh Belk with the Belk on Business podcast. Please consider subscribing if you haven't already. Have a wonderful day.